Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex language of corporate finance. And today we're diving into another SEC filing. This one from Traws Pharma Incorporated. And let me tell you, this report has more twists and turns than a roller coaster. Before we dive deep into Traws Pharma's financial story, if you love getting clear, no-nonsense insights from these dense corporate documents, make sure you hit that subscribe button. And hey, we've got a growing community on Discord where we break down these filings even further. So join us there, link is in the description below. So what is the big story with Traws Pharma? Well, it looks like they've had a bit of a rough financial quarter with cash reserves looking pretty thin and some serious questions about their ability to keep operating. Let's unpack what that really means. Alright, let's get straight to the numbers. This report covers the 3 months ending the 30th of September of 2025. It paints a picture of a company facing significant financial challenges. Looking at their balance sheet, total assets have dropped significantly to about $12.4 million by September 2025, down from nearly $25 million at the end of 2024. That is a big decrease, almost cutting their assets in half really fast. On the flip side, their liabilities are also down, but the way they've fallen tells a story. Total liabilities are now around $7.9 million, a huge drop from over $56 million at the end of 2024. This giant drop in liabilities is mostly due to warrants being reclassified or exercised. Back in December 2024, they had over $42 million in warrant liabilities. Now that number is down to just $11,000. This shows a massive swing in how they account for these financial instruments, and it is mostly because the terms of those warrants changed, allowing them to be moved out of liability and into equity, or they were exercised. Now this change in warrant liabilities, it is a huge deal. For the 9 months ending back in 2024, they had over $117 million in something called acquired in process research and development. That is a massive non-cash expense, basically writing off the value of research that had no immediate use. And then they had this change in fair value of warrant liability that added over $26 million to their financials. Fast forward to 2025 and those big non-cash expenses are gone, and the warrant liability has also dramatically reduced. This makes their net income look way better on paper for 2025, but it's crucial to understand that it is largely due to accounting changes and the removal of those big one-time charges from the previous year, not necessarily because the core business is suddenly booming. For the 9 months ending the 30th of September of 2025, they actually show a net income of about $16.6 million. Compare that to a massive net loss of over $136 million in the same period the year before, and it looks like a huge turnaround. But remember, last year had that enormous in-process research and development charge. The big story is the shift in warrant liability. The change here is largely thanks to how they accounted for warrants, not necessarily a dramatic improvement in sales or operations. Speaking of operations, revenue is not exactly setting the world on fire. For the first 9 months of 2025, they brought in about $2.8 million in revenue. That is a big jump from just $170,000 in the same period in 2024. This jump is mainly because they terminated a license agreement with Symbio Pharmaceuticals Limited in April of 2025 and immediately recognized all the deferred revenue, about $2.7 million. So while the revenue number looks good, it's a one-time boost from ending a contract, not from ongoing sales. They do not expect further revenue from this agreement. Now let's talk about spending. Their research and development costs are significant. For the 9 months ending September 2025, they spent about $7.1 million on R&D, down from over $10 million in the same period in 2024. This decrease is largely because they are trying to find partnerships for their oncology assets, and they've shifted focus in virology. They are preparing for phase 2 studies for 2 of their key drug candidates, Tivoxavir marboxil and Ratutrelvir, or TRX-01 as they call it. General and administrative expenses also decreased, dropping to about $6.2 million for the first 9 months of 2025, down from nearly $8.8 million in 2024. This is thanks to lower professional and consulting fees and reduced personnel costs. But here is the really critical part, folks. Despite the improved net income on paper, their cash situation is precarious. For the first 9 months of 2025, they used about $15.4 million in cash just to keep the lights on through operations. And looking back at the same period in 2024, they burned through even more, around $25.7 million. As of the end of September 2025, their cash hoard was down to just $6.4 million. This is significantly lower than the almost $21.3 million they had at the start of the year. They themselves openly admit that they do not have enough cash to operate for more than a year. This is a huge red flag, and it means there is substantial doubt about their ability to continue as a going concern. Basically, they are saying they might not be able to stay in business without a serious cash infusion, and soon they are actively looking for more money through equity financings, strategic alliances, and other sources. They did make a strategic acquisition on the 9th of September of 2025, buying certain assets related to a pyridine antiviral compound from Virium for $2.35 million. This is a related party transaction, as Nikolai Sabchuk, who is the CEO of Traws Pharma, has ties to Virium. This acquisition is aimed at bolstering their drug pipeline, which is understandable, especially given their financial situation. And speaking of acquisitions, the big one was the merger with Traws Pharma Therapeutics back in April of 2024. This brought in their two main programs, Tivoxavir marboxil and Ratutrelvir. They accounted for this as an asset acquisition, which means they bought specific assets, not a whole company. This deal involved issuing a lot of stock and assuming options, with the fair value of acquired assets reaching over $112 million. It's clear this merger was a pivotal moment for the company, shifting their focus heavily towards virology. Let's talk about their pipeline, Tivoxavir marboxil, is their investigational drug for bird flu and seasonal influenza. They've been actively working with the FDA on this, aiming for potential accelerated approval under the animal rule for bird flu. They've had meetings and submitted briefing packages, but the FDA seems to be pushing for clinical trial data rather than solely relying on animal studies. They've also had to defer initiating a phase 2 study due to concerns about recruitment, especially for the bird flu patients. Then there is Ratutrelvir, or TRX-01. For COVID-19, they acquired this in the merger too. Preclinical studies showed it is effective against various SARS, CoV-2 variants, including Omicron, and they are developing it without needing a co-administered CYP inhibitor like ritonavir, which is a plus. They've completed a phase 1 trial and have moved into a phase 2 study with positive early results and a good pharmacokinetic profile. They are expecting to report results by the end of 2025. For their oncology programs, narazaciclib and rigosertib, the strategy seems to be to find partnerships. Narazaciclib, a CDK4+ inhibitor for breast and other cancers, has completed phase 1 trials, and they are looking for partners to further develop it. Rigosertib was studied in patients with a rare cancer called RDSEC, showing promising results with an 80% overall response rate in preliminary data. They are also seeking partnerships for this program. It's clear their strategy for these older oncology assets is to hand them off to someone else to carry the development burden. Now, a quick note on their standing with Nasdaq. They've had some close calls with non-compliance, particularly regarding minimum stockholders' equity. However, they received a letter in February 2025 confirming they have regained compliance. They will be monitored for a year though, so it's not entirely smooth sailing yet. On the internal control front, they've identified material weaknesses. Basically, their internal systems for financial reporting were not updated properly after the merger. They are working on fixing this, bringing in consultants, and improving their processes. They believe they can fix these by the end of 2025, but the jury is still out until they can prove it. So, what is my take on all of this? Traws Pharma is clearly in a pivotal and frankly risky phase. The good news is they have a pipeline with some intriguing candidates, especially in the virology space, and they have managed to regain Nasdaq compliance. However, the pressing issue is their liquidity. Burning through cash at this rate with only $6.4 million in the bank is a serious cause for concern. The improved net income is largely a result of accounting adjustments and the prior year's massive write-off, not a sign of robust operational growth. They need to secure significant funding and fast to avoid a going concern situation. The success of their drug candidates hinges not only on scientific breakthroughs, but also on their ability to navigate the complex and often expensive path to market, whether through partnerships or further equity raises. The market conditions and potential government shutdowns also add a layer of external risk that could impact their ability to raise capital. It is a high stakes game they are playing, and while there is potential, the risks are very real and present. Alright, that is our breakdown of Traws Pharma's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.